Joining us on the phone from Villanova, Pennsylvania to discuss oil price concerns is Stephen Schork, author of the Schork Report and president of the Schork Group. Stephen, always good to have you on. Thanks so much for your time today.
It's great to be here, Mark. Thank you.
Stephen, how concerned are you about the situation in Egypt? As I mentioned, it appears to be getting worse.
It absolutely is, Mark, and quite frankly, I'm sitting on the sideline because volatility has absolutely spiked. I bought a lot of oil down in the high mid-80s last week, and I've been scaling out, taking profits on the way up. I'm still long right now. I've got about $1, $2 above where my drop dead number is, where I pull out. But basically, Mark, what I'm saying is I'm buying a $2 lottery ticket because if this thing does escalate, well, as you said, we're already trading over $100 in the European markets, and certainly a run towards 95, 96 in the New York market cannot be ruled out at this point.
And Stephen, as you know, when you and I have a chance to chat, we always talk about the effect that this is going to have on consumers. The folks who are watching at home, listening at home, what should they be concerned about?
They should be concerned about the sustainability of $100 oil, that if the situation in Egypt does escalate, you see more investor money pile in and to hedge this risk, then we're talking about oil here in the United States close to $100. The concern for the average Joe on the street, Mark, is that $100 translates into greater than $3.30 at the pump. We know from recent history that demand inelasticity begins to wane. Consumers will begin to alter their behavior as they have to pay up. Mind you, we're paying right now 3.8 cents on our dollar towards energy, and that was in the fourth quarter.
Right.
We've had a nice rise in price, so conceivably we could be paying over 4 cents on our dollar going towards energy into the summer. That could mean $3.30, $3.40, $3.50 at the pump. It will cause pain, and we do run the risk of slowing down this economic recovery.
And we did see Brent crude rising as well, over $100 a barrel this week.
And absolutely, and that's the concern, because the New York contract, we have a major disconnect, because the New York contract is a higher grade, higher quality oil, typically trades at a $1 to $2 premium to the Brent contract. Now the New York contract, because we have a glut of supply in the Midwest, is actually trading at a $10 discount. So if this market mean reverted back to where Brent is, New York oil would already be over $100 a barrel.
And Stephen, if I might ask in our last 30 seconds, these rising prices of oil, that also threatens airlines, because we could see them having some problems returning to sustainability or profitability because of this.
Oh, that's right, Mark. And the airlines and the people I talk to in the airline industry, they are horrendous when it comes to hedging their fuel costs. So any uptick this summer, they're going to hurt in a big way.
All right, Stephen Schork, president of the Schork Group, joining us on the phone. Stephen, always good to have you on. Thanks so much.
Thank you, Mark.